Hello everyone and welcome to another market update. Today is the 26th of Feb, couple more days left in Feb. Top three things today are the quad environment, so quad 4 is what we're currently in. Number 2 is the US dollar, and number 3 is volatility. I want to start off with the quad environment because this is really important for you to get your head around, especially because the quad framework is what I use to govern how we invest and when we make investment decisions. So we were in an environment just prior to, and I've got a table here of the monthly quad map. We've been in an environment since really August of last year where we've been in a quad 1, 2, or 3 environment. Made a lot of money during that period of time. You saw a lot of the large cap tech and other exposures we have on doing very well. One other part of the market that did very well was the crypto space. All of a sudden, we run into this monthly quad 4 environment. And for the most part, the month of Feb hasn't been too bad in terms of that quad 4 environment manifesting itself. But really in the last probably, I'd say 10 days, even week, we have seen the markets just go pear-shaped and really pricing in this quad 4 environment. Probably because we've had some data points that have come through. I think consumer confidence has fallen a little bit, and some of the other manufacturing, PPI metrics, things like that have weakened a little bit. So because that economic data has been, and some of the consumer confidence stuff has been a little bit shaky, that's being priced in by the market. And now what's interesting is, in particular, the crypto space where this has gotten really ugly. And this is just a table with a bunch of the crypto coins on it. But Bitcoin is there, of course, and some of the other biggies like Solana, Avalanche, Ripple. But what you can see there is basically red. It is a sea of red. It is the bloodbath in crypto at the moment. And crypto, in fact, Bitcoin has really gotten smacked around. So post Trump's election and then post his inauguration, we saw all-time highs in crypto. It got up to 109,000 USD per Bitcoin. I think maybe even a little bit higher in AUD terms. But having said that, we've seen a huge sell-off in Bitcoin, and that is quad 4. Quad 4 is one of the only environments where you do not want to own crypto. The other three, 1, 2, and 3, quads 1, 2, and 3, I should say, Bitcoin and the cryptocurrencies typically fine to own. So again, this is just, I'm just saying that with the quad 4 environment we're in, it should be no surprise to anyone who owns those assets, if you still own them, that they're getting smacked around. The good news is we're about to bounce out of that. So we've got 2 days left in February. And not that just because March 1st shows up that we'll be into a quad 2 environment, but what this quad map is showing you is that the months from March right through to June and end of June, we're back in a quad 2, 3, or 1 environment. That will be good for, just like it was back here, from August, the month of August forward. That'll be good for all the large cap tech, crypto, other sorts of growth assets that we had been holding up until this month. So one of the things I did sort of early Feb, late Jan, early Feb, is I sold down some exposures, raised some cash to soften the blow of this quad 4. Probably should have done a bit more, but anyway, is what it is, and I am now starting to put that capital back into the market. I'm taking advantage of these sell-offs because of what is coming down the pike, and that is a return to this growth environment. How do I know we're going to get there? Well, I don't know. I mean, we're going to do sort of and look at what the market is doing, which is one of the reasons why I'm not just piling back everything back in on any given day. I'm scaling back in slowly because, let's face it, as the month of March unfolds and this environment, this next quad 2 environment unfolds, there'll be plenty of time to reallocate capital. And knowing that we've got that environment for the next sort of 4 months, there's no rush to pile back in. And if I can get a slightly better price on a few of these things, even better. So that is, I guess, probably all I really need to say about the quad environment. But we've had a rough month in Feb, to be sure, and but I want you to know what is what we're looking at going forward, and that capital is now being piled back into the market. So I am well and truly anticipating that we're going to be back to seeing some healthy, good balances in your investment accounts. So that's the quad sitch. Now, the next thing I wanted to touch on was the U.S. dollar. The U.S. dollar has begun to weaken, and this is the U.S. dollar index. This is a chart of the U.S. dollar index. As you can see here, it was up around 109 on the index, almost 110, which is really quite high for the USD index, and it's really come off that. I'm not sure what that's signaling. Probably that interest rates in the U.S. may begin to be cut again, possibly, or that there's just market forces where the U.S. dollar had too much of a run and it's being sold off now in favor of other currencies, whatever. But the point is that the U.S. dollar index is coming down. And one of the things I don't talk too much about anymore, but I have started to reintroduce into these conversations, is the correlation table of the U.S. dollar to other asset classes. And so this is a correlation table showing some large asset classes like Bitcoin, gold, the commodities index, oil, and the S&P 500. And it does it over a short duration, like 15 days, and a longer duration, 180 days. So, and everything in between. And so what this is all about is when we have a negative correlation, it means that when that thing, like the U.S. dollar, moves in a direction, the asset class that's negatively correlated moves in the opposite direction. So if the dollar is rising, over a short period of time, we would expect the S&P 500 to be falling, CRB index to be falling, gold to be falling. If the U.S. dollar is falling, we would expect these things to be rising. Now, probably what I'm more interested in is the longer term sort of trajectory with this, but as you can imagine, as we go out further in time, these negative correlations or positive correlations will begin to populate these longer term durations. So really, it's just worth noting, because if you get the direction of the dollar right in global macro, you tend to get the direction of other things right. So this is the table that I'm paying acute attention to, because as the dollar continues to fall in the short term now, this is the likely outcome for some of these other asset classes like the S&P 500 should be rising. So anyway, I just thought I'd point that out because it's kind of an interesting thing to note. And from a sort of global currency point of view, I certainly want to see the dollar probably having a bit more weakness, because it means that we will not be importing as much inflation. You know, I talk about inflation a lot. I'm not talking about that today as a top three thing, but it's correlated to the US dollar as well, because if the dollar is very strong, it means that, as I've said ad nauseum on these updates, that we then import that inflation to Australia, and it eventually makes its way into our inflation figures here. So it's actually going to be interesting, and I haven't even really talked about interest rates at all today, but to just quickly touch on those, we did have a rate cut here in Australia, and which I thought that they would not do a rate cut, but I think there's probably a tremendous amount of political pressure to give some relief, in particular to mortgage holders, and it's probably more symbolic than anything. Like a 25 basis point cut isn't really going to make a big difference to the average mortgage in Australia, or in Sydney, even for that matter. I think it might translate into $100 a week or something like that. You know, it's like big deal. I mean, that's real money. Don't get me wrong. Like I'm happy to have $100 a week extra in my pocket, but in the grand scheme of things, that is barely scratching the surface of our weekly shopping bill. In any case, always nice to get a rate cut. I don't know that we're going to see any more this year. I don't know. That remains to be seen, and we'll have to be. I think we'll have to watch the Aussie dollar to see what it does, and the Aussie dollar has strengthened, so it's up around 63.5 cents, something like that, which is nice because it was down around the 61 and a bit range. So it is nice to see it popping a little bit. Anyway, moving on to actually, since we are on the subject of inflation, I will quickly touch on that, because I think this is one of the reasons why the U.S. dollar is breaking down. Hedgehog does a fantastic job on their inflation nowcasts, and they're the best of breed and best on the street in terms of Wall Street in predicting inflation. Now, this is a huge indicator, because what this helps us do is it helps us get an understanding of what's going to be happening in the bond market, and maybe even explaining some of the moves that are happening in the bond market. And it allows us to anticipate what potential moves the Fed might make in the coming months. So what we have is inflation ticking down, which is great, right? That's what we actually want. We want inflation ticking down. Having had 3, 4, 5 months here of inflation moving up, what's interesting is the Fed hasn't caught up yet. They were talking in their last meeting about, being cautious about inflation, and maybe they'd have to do an interest rate increase. And they're going to be maybe surprised or pleasantly surprised when inflation ticks down in the month or for the month of Feb, which we won't get that data point until March, which we'll report, which is always a month behind, of course. But that's good. Hopefully, directionally, we will continue to see inflation falling. Now, that's going to be a good thing for markets because it's going to signal that if inflation is falling and we have decent growth and so forth in the economy, the Fed may be able to lower rates a bit more and not have to worry about inflation restoking. Again, it's a delicate balance with what the central banks do, but hopefully we'll continue to see some interest rate relief. That will be seen in the bond market, and what we have seen in the U.S. bond market is interest rates across the curve, so short 2-year, 5-year, 10-year, and then out to say 20 and 30-year rates are coming down. And that's probably a sign that the bond market is saying, okay, they know this, right? The bond market must be anticipating and know that inflation figures are actually coming down. So that's good. That is a good thing. That's what we want, and that will drive further growth in the stock markets. Now, I thought I'd also just quickly touch on volatility because we have had a fairly interesting volatility setup over the course of the last month. And I say interesting because, and I'm looking at my vol chart here of the S&P 500, we had volatility at the very beginning of February sitting at around a high of 20. That was on the 3rd of Feb. It then sort of pulled way back, and that's why I'm saying we didn't have this quad 4 manifestation in Feb until this past week. So the 21st of Feb is when vol spiked again, and it has gone up to and closed yesterday at 19.5, let's call it for a nice round number. However, it didn't break into the sort of chop bucket, which is that 2021 vol plus. So that's a good thing. Hopefully right here in this very spot, we're going to see volatility roll over. That would be great if that happened, because what will happen is we're still in the investable bucket. And for those of you who might be joining this for the first time, there's 3 buckets of volatility. I've got a bug flying around my face. The investable bucket, which is sort of 9 to 15, 18 vol. Then you've got the chop bucket, which is about 19 to 23, 24 vol. This is on the S&P 500. And then once volatility gets above 25 to 30, that starts to get into the uninvestable bucket. There's some event that's caused the volatility to go that high, and that's usually a bad sign for markets and a sign that we want to take our money and put it into cash or something very defensive. So again, we're in that vol environment where it sort of failed at this level of vol at the beginning of Feb. And so we're just going to have to wait and see what happens. But what I'm hoping for, I mean, hope isn't a risk management strategy, but what I'm hoping to see in the next couple of days is that volatility continues to come out of the market. Now, one of the things that drives volatility are big events, and we do have NVIDIA reporting earnings, I think tonight. If not, it'd be on Thursday, so Friday our time. It's either tonight or tomorrow, Australia time. But nevertheless, that event will attract some volatility, or could attract some volatility. Now, recently we've been having some companies reporting earnings, and they haven't been the best. They haven't been great. We've had some companies reporting good earnings and beating estimates and so forth. We've had other companies, big ones, coming out and reporting sort of so-so earnings, and they're getting smacked around. And that's, again, another reason why we might see some volatility in the markets. So, or one of the things that might drive some volatility. But again, I want to pull right back and go back to the monthly quad map and reset what my thinking is and what I'm expecting for the next 3 to 4 months. That is a return to that expansionary environment. Probably see the dollar hovering around where it is now, maybe falling. We'll just have to see. Hopefully we will see some opportunity for interest rates to come down a bit and just further growth come into the market, and then further confidence and people wanting to get invested in the markets and money piling back in. That's how I'm setting up. That's what I'm doing. I'm taking again advantage of the sell-off in markets to reallocate some capital with a view that if this is the anticipated quad map, well, I want to be back into crypto. I want to be back into growth, and I want to be back into basically not cash and not fixed income type investments. So with that, I think we are updated. As always, I'll keep an eye on markets. I will come back with another market update next week, the beginning of March. Who knows? We might have, over the next 2 days, see the markets start to discount the fact that we're heading back into that quad 2 and 1 environment. Wouldn't that be nice to have a couple of nice big up days in the market, having just had kind of a smackdown in the S&P 500, in the Russell, in the NASDAQ. Be nice to see them bounce sort of from these levels and head back up. We'll just have to wait and see. With that, I will say have a fantastic rest of the week. And as always, if you need to or would like to book in an appointment, you can get access to my calendar in my email footer where it says book a meeting. You can, of course, go on the website and do it from there as well. All the best, and I'll talk to you all soon again. Cheers. Bye.